Okay, for chapter 10, we're going to learn on accounting for liabilities. So as you can see here, this is the learning outcomes for chapter 10. So we're going to go through the definitions and types of liabilities. You have two types of liabilities. One is current liabilities and the other one is non-current liabilities. And then we're going to explain the characteristic of these liabilities. And we're going to record the issuance of liabilities, and then we're going to separate the issuance of the liabilities depending on the period of the liability, that is for your current liabilities and also for your non-current liabilities. And finally we'll see the presentation of liabilities in the statement of financial position. Okay, so what are liabilities? Okay, liabilities is actually an outsider claims against asset. Okay, so in Malay it's actually hutang. Alright, it's actually hutang perniagaan. Alright, so these existing obligations and debts are due to past transactions. Okay, so paying off liabilities would probably involves the outflow of economic resources from the organization. Okay, so there are two types of liabilities. You have, first one is the current liabilities. Okay, so in current liabilities, you're gonna have two types of current liabilities. One with a certain amount, okay, and the other one is with an estimated amount. So for certain amounts, you have accounts payable, short-term notes payable, accrued expenses or expenses payable, unearned revenue, and also sales tax payable. And for estimated amount, you'll have warranty liability. So these items are called current liabilities because the debts that the company expects to be paid within 1 year. Okay, that means less than 12 months. Right? So that is why it is classified as current liabilities. Whereas for non-current liabilities, it is an obligations towards external parties, okay, which is not due within 1 year. That means more than 1 year. So the reporting period is longer than 12 months. So the examples of non-current liabilities or long-term liabilities is long-term notes payable. Okay, notes payable you have in current liabilities as well, but you also have notes payable in long-term liabilities. And then you have mortgage payable and also bond payable. All right, okay, we'll go through the current liabilities. Okay, first of all, you need to understand the current liabilities with the certain amount. All right, so the certain amount is something that you already know how much you are supposed to pay to the third party. Okay, so this is the item that you can determine accurately. All right, one of it we've learned earlier, okay, is accounts payable. All right, so accounts payable is an amount that you owe to the vendors or to the suppliers for any goods or any services purchased on credit terms. So how do we journalize the accounts payable? We will debit purchases and we will credit accounts payable. Okay, we'll go through example 1. The company purchased 15,000 of goods on credit terms from Syarikat Indah on this particular date, that is on the 16th of February 2014. So how do we journalize the transaction? So here we're going to debit, since it is a purchase and it's on credit terms, so we will debit purchase and we will credit accounts payable. So this accounts payable is under the name of Syarikat Indah, and the amount is 15 15,000. So these are the obligations that the company needs to pay within 1 year. Okay, this is how you record your accounts payable. Okay, another type of current liabilities is your short-term notes payable. Okay, short-term notes payable is actually a written promissory note. Okay, so this is signed by the company, and since it is a current liabilities or a short-term notes liability, it is payable within the year, less than 12 months. And the company recognizes liability to repay principal, the amount borrowed, and interest on specific date in the future of the bearer. So you need to determine, okay, how much principal you need to pay together with the interest on the future date, and that future date is called maturity date. So you need to pay the amount that you borrowed within the specific frame of time. Okay, so this is frequently issued to meet short-term financing need. Okay, you need the money, but you don't want to borrow for a long period, so you will issue an notes payable. Okay, so if you were to issue the notes payable, you will do 2 journal entries. Okay, one is during the issuance of the notes payable, that is on the day that the notes payable is issued. Okay, hari kamu issue notes payable, masa tu kita meminjam, so you receive the money on that particular date. That means we will debit bank and we will credit notes payable. Okay, so at this point you receive the loan, the pinjaman. Okay, so it can be either cash or in a form of check. It should be bank. Okay, so then you need to pay the amount that you borrowed within the maturity date applied. Okay, so when we are surrendering the notes payable, that means when you are paying the notes payable, okay, to meet up with the maturity date. Okay, so you need to debit the notes payable because you are surrendering the notes payable, so you are closing the account. Okay, and at the same time you are paying for the interest. So here you are paying for the principal and you are paying for the interest as well. So the amount credited here is principal plus interest. Okay, all right, so we go through the example given. Okay, before we can record the payments or the settlement of the notes payable, we need to know how to determine the maturity date to calculate the interest expense on each notes payable. So in this question you are given a few situations. All right, so you have 5 notes payable that is issued on different dates with a different amount and different interest rate. Okay, you need to bear in mind this interest rate is per annum. Okay, that means this is for 1 year. All right, so we are not paying the whole amount of the interest because we are not borrowing the money for 12 months. We only borrowed the money within the period given. Okay, so you are supposed to pay the notes payable within the maturity period. Okay, all right, so we look at the first one. Okay, how do we calculate the maturity date? Okay, the first one, the notes payable was issued on 10th of January. Okay, and given in the question, the maturity period is 90 days. Okay, so from 10th of January until 31st of January is 22 days. Okay, how do we calculate the 22 days? We will start from the day of the issuance. That means 10th of January will be included as well. So 10, 11, 12 and so forth until 31st is 22 days. Okay, so you need to remember your maturity period is 90 days. Okay, so next you have 1st January until 28th of February. Sorry, 1st February until 28th of February is another 28 days. So here, right, you already have 50 days. Okay, so we'll proceed with the calculations. Okay, next we go to March. From 1st March until 31st of March, this is another 31 days. So here, you already have 81 days. So your maturity period is until, alright, another 9 days. That is from 1st of April until 9 of April. So that concludes the 90 days maturity period. So your maturity date is on the 9th. So if I were to record the journal entry, I will have two different dates. The first date will be 10th of January, the date of the issuance. And when I am settling the notes payable, okay, I'm paying the notes payable, the journal entry will be on the 9th of April. Okay, how much are you supposed to pay? The principal is 8,500, so I need to pay 8,500 as usual. Okay, and then I need to pay for the interest as well. Okay, so you are paying 8,500 for the principal, and the interest is 9%. Okay, times 8,500 times the maturity period. Okay, your maturity period is 90 upon 365, because we have 365 per year. Okay, so that concludes to the amount of 188 ringgit and 63 cents. So the amount that I need to pay on 9 of April will be 8,500 plus 188 ringgit and 63 cents. Okay, so that is the amount that I need to pay on 9 of April. Okay, we look at the second situation. The issuance date is on the 15th. So if I were to record the issuance of the notes payable, the journal entry will be dated on the 15th of April. So when is the maturity date? So the maturity date will be after 120 days. So when is that? So from 15, you'll calculate from 15th of April until 30th of April, that is 16 days. And then next we go to May, another 31 days. So here you already have 47 days. Okay, so we add up another 30 days in June. Alright, so here you already have 77 days. Okay, we are adding up another 31 days from July. Alright, so you already have 77 days before. We add up another 31 days. So until here, you already have 108 days. So the maturity period is within 120 days. So you need another 12 days. So 1st of August until 12th of August will be your final 12 days. So here, that concludes the amount of 120 days. So the last day of the notes payable maturity period will be 12th of August. So this is the date I issue the notes payable, and this will be the date that I am surrendering or I'm paying for the notes payable. So how much do I need to pay? Your principal is 7,200 and your interest is 8% from 7,200. but you need to multiply with the maturity period. Your maturity period is 120 days upon 365. Okay, okay, we'll go through the third one. All right, okay, for the third one we'll be doing the same thing. Okay, so your date of issuance is on the 27th of June. All right, so if I were to calculate the maturity period for this notes payable, okay, within 120 days, so my maturity date will be on the 24th. So how much do I need to pay on the 24th of October? I'll be paying 6,400. That is the principal, including the 105 ringgit and 21 cents for the interest. So these two items will be paid on the 24th of October. All right. Okay. Next, you have a notes payable that is issued on the 12th of October, and the maturity period is 45 days. So for this one, all right, the maturity date is on the 25th of November. So the amount that I need to pay on the 25th of November is 8,800 plus 81 ringgit and 37 cents. So you need to pay 8,881 ringgit and 37 cents. And the same thing goes to the last part of it. Okay, so the final one, you need to pay 7,700 of principal and 126 ringgit and 58 cents for the interest expense. Okay, so we look at example 3. First National Bank agrees to lend the company 20,000 on 1st of January. Okay, so 1st of January 2010 will be the date of the issuance. Okay, so the company signs a 20,000 ringgit of notes payable. Okay, and the interest rate is 12% per year. So it is given in the question, the assumption is 360 days per annum. That means you only have 360 days for that particular year. Okay, so the question instructed you to prepare journal entries to record the cash received upon the issuance of the notes payable. Okay, and then we are to record the payments of the notes and interest on the maturity date. Okay, so first of all, you need to calculate your maturity date. When is the maturity date? Okay, the notes payable is issued on 1st of January 2010. Okay, so until 31st of January, that will be 31 days. Okay, so from 1st of February until 28th of February, that will be 28 days. So here you already have 59 days. Okay, so you need another 1 day. All right, okay, so that 1 day is on the 1st of March. Right, so 1st of March will be your maturity date, and 1st of January will be your issuance of notes payable. Okay, all right, so how do we record the issuance of the notes payable? Okay, so the date for the issuance is on the 1st of January. Okay, so on 1st of January, I receive money upon the issuance of the notes payable, so I will debit, it's either cash or bank, with the amount of 20,000. Since this is a liability, so notes payable will be credited. Okay, so this is to record the issuance of the notes payable. Okay, so within that 60 days, I need to settle the notes payable issued. Okay, so when is the settlement? The settlement is due on the maturity date, that is on 1st of March. All right, as we calculated earlier. So on 1st of March, you need to make two payments. One, you need to pay for the principal, which is 20,000. The second one, you need to pay for the interest expense. So both amounts will be credited from either your cash accounts or your bank account. Okay, so the amount that you need to pay on the maturity date is 20,394 ringgit and 52 cents. Okay, so where do I get 394 ringgit and 52 cents? Okay, that is actually your interest expense. So as given in the question, all right, your interest is 12%. Okay, this is actually 12% from the principal, which is 20,000. Okay, and the tenure is 60 days upon 365. So that is how you come about with the amount of 394 ringgit and 52 cents. Okay, so that is how we record the issuance of notes payable.